Hello, everyone, and welcome to the taxable account review for the month of December. And yeah, I'm really trying to shorten these videos, so let's jump into the numbers. I am not a financial advisor. I do not claim to be one. This video does not reflect the views or opinions of my employer. I do hold a number of shares in common with John and Jane, and I have those listed on the screen. And this is a real portfolio with real shares being traded. And so that's why I include so many screenshots to help validate that. Just a real quick, why do I do this? John and Jane, in my opinion, were being taken advantage of, and I've been working with them for about over a decade now. Frankly, after talking to them, just talked about the idea of them managing it themselves instead of having a financial advisor, and they decided that that was something they wanted to do. And when it came to writing the articles that I originally did and then making these videos, I just asked that that they let me present things to other people that don't necessarily have someone like me to be able to do this with them, so that hopefully I can empower other people to do it. I tend to get angry about things, and I find when I get angry that I need to do something about it. So that's kind of how we got to where we are today. And then for their background, both of them are retired. Both of them collect Social Security, and they currently withdraw $1,700 a month from the taxable account, and then they withdraw $1,000 a month from John's traditional IRA currently. They do have other investments outside of what I help them with, but this is the bulk of what their retirement is. And they do not have any other monthly debts, so they make my job very easy in the sense that they live a very practical life. They own everything that they have free and clear. So in the taxable account for December, they generated just under $2,150 for the month of December, and that compares with just under $2,170 for December of 2022. And then in the account, the balance has improved quite a bit in recent weeks, I really should say, but ended the year at $555,000, and that compares with the $527,000 that they ended the year with last year. And the annualized cost basis, so basically what is the portfolio yielding on the original investments that were made, is 5.51%. So the idea there is that they're making 5.51% on their initial or original investment. 5 companies in the portfolio paid an increased dividend or a special dividend during the month of December, and there was one company that did slash its dividend, and I will talk about that further. And then for the increases, Emerson did their normal 1% increase. Emerson does this pretty regularly, even though they have a great increase track record in terms of the number of years. They are a pretty fast growing company. They're using their money for expanding what they do. And so it makes sense that they have been offering some pretty limited dividend increases. And then Equinix, I've never known exactly how to pronounce that name, increased by a whopping nearly 25%. They have, and that stock price has shot up. We did trim back the position a little while ago, but that was some higher cost shares. We still have the core of the position being held. And then for Honeywell, increased just under 5%, which is pretty common with what we've seen in recent years. And then for McDonald's, the increase of just under 10%, also fairly common, and even actually a little bit on the high side for what we would normally see from McDonald's. I think there's a lot of growth opportunities, and I think that McDonald's is definitely the first fast food chain to really start pushing into the area of the efficiencies of robotics and automation and things like that. So I think that that should be pretty interesting in the years to come. And then for Exxon, increase of 4.4%, which is pretty normal from what we've seen from Exxon recently. So that's all within the norm. Now, the dividend cut came from VF Corporation. Anyone who's been following them knows that they have been struggling terribly lately. And when it comes to their dividend, they had it cut previously, and the new CEO is in, and basically I think that the company looked at everything and they just said, look, it still is important for them to pay a dividend in terms of what funds will like ETFs and different funds that will carry that stock as a holding. So they know that they still need to pay some sort of a dividend, but cutting it again wasn't really something that was going to hurt them that much more than that it had already hurt them. I mean, that's why you notice that the stock price has basically stayed stagnant. So the new CEO's name is Bracken Darrell. He actually has experience with turnaround companies like Old Spice and Logitech. We're willing to give VF Corporation through 2024 to kind of demonstrate that things are trending in the right direction. So we'll see as the year goes on what happens with their organization. But their decrease was a reduction of 70%. On the lot details here, one of the things I'm starting to include now is a little bit of math to help give perspective to maybe what the position has provided previously and what it's going to be providing in the future. So, for example, the last 3 years worth of history, technically 4 years, Emerson has paid $1,432.42 of dividends. But moving forward with the existing position that we have, we expect to see about $367.52 of dividends. So what you can see is that previously the size of the position, if we was to take 367.52, multiply it by 4, we'd get about in the same ballpark here. So the positions have been about the same size the entire time. Now for Equinix, this is a position that's changed quite a bit. You can see that since June of 2021, which is when the position was established, it's paid $390.17 of dividends since then. But every year it's set to produce $170.40 of dividend income. So what this tells you is that the size of the position has actually increased pretty substantially over time. And then for Honeywell, this is a very small position. We try to only buy when the cost basis is really low, and just with Honeywell, it's just really hard to get the price to drop down to the level that we're interested in adding more shares at. But it's paid a total of $109.40 of dividends since September of 2020. But as you can see, we doubled essentially the position in 2022. So now you can see that the annual amount that's paid, the $43.20, is quite a bit more than what was generated here. So basically, it's doubled in size, and that's why you see it paying so much more in dividends than what it was originally. And then for McDonald's, you can see here on this one that McDonald's, everything was accumulated for the most part within a very short period of time, everything within 2020 here. So in this case, you're going to see that if we did the math on this over 4 years, going back to March of 2020, that this adds up to about what we would see here. And then obviously add in the dividend increases every year. So McDonald's has basically stayed the same size the entire time. Now for Exxon, this is a position that has changed quite a bit over time, but we've also sold off a number of shares because there were some higher cost shares that once the stock price recovered, we did trim it back and then kept the cost basis, the rather low cost basis shares that we did have. So if with Exxon, it would be expected to generate $665 a year, which if you do the math on it, ends up being close to about where the position is currently. And then for VF Corporation, this is where it's kind of sad. So VF Corporation was paying a pretty hefty dividend before, at least relative to what it is now. And so this is a position that's been held for quite a while, but since March of 2020, it's generated about $820 of dividends. But now after that dividend cut, it is going to generate only $63 a year of income. So as you can see, it's a pretty substantial drop that we've seen from VF Corporation. Now for the trades in December, we ended up moving $15,000 into the Schwab money market, and that was just because the buying opportunities have really dried up with the market rally that we've seen. But with Westlake, we did eliminate that position. The big thing here is that the yield on Westlake, although higher than a CD, there's been no distribution increases. I use the word distribution because it is a K1 company. And so frankly anymore, it doesn't have a value proposition that it used to have. It used to be, much like the pipeline companies where it was raising its distribution every quarter, even if it was by a small amount. And so in this case, it's become, in my opinion, dead weight. There just isn't a lot of upside. And so frankly, we'd rather put the money into something like a certificate that's going to yield just a little bit less, but have no volatility with it. And then for the realized gain loss, you can see here that with Westlake, part of the other reason why we sold it is that we were pretty much selling it at a break-even cost. So it was a good time to eliminate the position. And then for the gain loss for the year, so I've always talked about how it's really important to manage your taxable liability when it comes to a taxable account. And so in this case, we're always trying to balance when we sell shares at a gain, that we're selling shares at a loss. And you'll notice that the gain-loss ratio, when you compare it with the traditional IRAs and the Roth IRAs that John and Jane have, that the gain-loss ratio for the retirement accounts is like usually in the 85-ish% range. So here it's going to be closer to the 50% range because we truly are trying to make it where this net loss ends up being about zero. Now, give or take, if it's a little bit in the positive, a little bit in the negative, that's not that big of a deal. But the goal is to keep both sides of the equation balanced. And that's just strictly for taxable liability. Now for the year-over-year comparison with December, Simon Property Group is the remaining position that's been trimmed the most. We eliminated the high-cost shares in favor of maintaining a smaller number of shares at a much lower cost basis. Also, we can see that with VF Corporation, the dividend in December of 2022 was $102, and now that has dropped to $15.75. So again, pretty substantial decrease. Shares no longer held in 2022 were actually the interest that was received from CDs that have since expired. And then the portfolio is generating CD income, but now it also has the money in that was moved into the Schwab money market account, and so that will be reflecting in the next month. And then for the full year-over-year comparison, this is where we can show that the increase across the taxable portfolio was 5.6%, and what's nice about that is that it had steadily been increasing towards the end of the year, but that's up from 5% that we were expecting in November. So even though the income came in lower for the month of December in 2023 than it was in 2022, that's mostly because of the year-end dividend issuances, especially from like the funds like EVT and things like that. Actually, I think it's Eaton Vance's the EAFAX is where some of it came from, it's one-time special issuances in December is part of what caused this to be lower, but the estimate that we had was lower for 2023 here, so the fact that it came in higher is part of the reason why the increase year over year went from 5% up to 6%. I think that, the Fed's hinted at lowering rates. I think that there's a lot of second guessing going on with that right now. I personally, if you guys have been paying attention to the videos, know that I am not optimistic. I am not a fan of the idea of lowering interest rates, but we won't get into that subject. But in this case, yeah, they've been withdrawing $1,700 a month, and we'll look at that in another screen. But what I like here is that the $1,893.01 is basically what we're saying John and Jane could withdraw now and still remain cash flow positive. So that amount is increased just over $100 per year. And so a cool way to think about this is that by literally doing nothing, right? And by nothing, I mean, not having to work, not having to add money to the accounts, but just by having made some changes in the account and then collecting the dividend increases, even with the decrease that we saw from VF Corporation, they are earning another $100 more per year than they were last year on average. And so that's kind of the value proposition here with the dividend growth model. So as far as the account balance goes, you can see where we ended the year at a pretty substantial amount higher, about $27,000 higher. But also we can go back in and we can add in the funds that were withdrawn from the account. And the reason why I do that is just to say, okay, if John and Jane chose to not take the $20,400, what would the benefit to the account have been? And in this case, what you can see is that it's one of those rare moments where you can have your cake. That's it. You can have your cake and you can eat it too. I never completely understood that saying, but you get the point. That the idea being that not only was their account balance increased, but they also were able to walk away with $20,400 even with the increase that we see here. So that's part of why this model works so well in retirement, is that even if the market ended up being down, like for example back where it was in October, John and Jane can still walk away with their $20,400 even if the market, the balance of their portfolio was down. So the balance that's in the portfolio, yes, it's a number that matters, but it's not a number that matters in the sense that it dictates what income and benefit that they're going to receive in their retirement. So from the income, from dividends and interest, since inception, it's increased by 17.5%. Now, I think it's fair to point out that in 2018, part of the reason why this number was so much lower was because of the fact that we were just initiating and starting the portfolio at that point in time. But if we were to go to the other video that looks at the portfolio, like the entire portfolio, so all of their accounts as a whole, it was a cost of average goods returned of 10.4%. So just imagine if your money was growing at 10.4% on average year over year, through the good years and then the bad years. And so in this case, I think that that's a reasonable number that we've seen from them, and because it's been measured over the last 5 years. But depending on 2024's performance, something that would be really cool to see, even though I'm not necessarily, banking on it or saying it has to happen, is that it's possible that the amount of income generated could end up exceeding the $24,000 marker, which means that the portfolio will be producing almost exactly double the income that it did in the first year of inception. So again, first year of inception is going to be light in terms of how much income was generated, but it would still be pretty cool to see this total balance or total amount received above 24,000, because it does continue showing that progress being made. And then for the cash balance comparison, cash balances remain high. they're still down compared to previous years if you're looking at the averages down here. However, the caveat here is going to be that if we add back in the $15,000 in Charles Schwab money market and then the $30,000 that's currently in CDs, then we would be sitting at a 6-year high for cash on hand when it comes to the taxable account. So also it depends on the time of year and how many months these this was held in here. And then also some outliers too, like when you look at 2020, which was the last time that funds were added to and then taken from the account. And then for the unrealized gain loss comparison, you can see that the unrealized gain loss has improved significantly in December. So we ended the year basically at the second highest point, with only July edging it out in terms of the end of the month balance. And then just as another reminder, we're extremely diligent with what's bought and sold in the taxable account. So when you look at the unrealized gain loss here and you compare it with the tax deferred portfolios, so like the retirement accounts are likely to carry lower unrealized gains. And the reason why is because we're more likely to sell out of those accounts than we are out of the taxable. The taxable we're more likely to continue holding simply because if we sell, then there is a taxable liability that's potentially created. And for the withdrawals, you can see in 2022, it was $12,000 for the year at $1,000 a month. And then in 2023, it is $1,700 a month. And that's where we get the $20,400 that was taken from the account. So basically, $8,400 extra is what John and Jane have drawn out of their account. For those who are wondering, John and Jane decide what they want to draw out of their account. I just usually ask that they keep it below the cash flow of the account. But in all honesty, most of the time I'm the one that has to push them to take money from their account because typically for them, they'd rather just leave it there. And that's just the way that they've always handled their finances, is they've just had in a conservative sense. Another thing too is that I mentioned previously that no funds have been added to the taxable account in years, so since 2020, beginning of 2020. And so I think it's really important to consider the fact that, these increases that you're seeing, all this is happening on just the funds that are already there. It's not like, a bunch of funds got added into it overnight, and that explains why the income has gone up or why they're able to draw out more. Now, on the current gain loss table, you can see here where basically it's VF Corporation and Washington Trust Bancorp. Those are the two big losers right now, along with Altria. Otherwise, everything else is sitting at a fairly moderate loss, if any, hardly any loss at all. Everything else is in the positive. These numbers are accurate as of December 29th. So the portfolio has been performing extremely well up to that point. And for the conclusion here, so basically market ended the year on a strong rally, but I'm just very skeptical. I just think that there's too many headwinds, and especially in certain segments of the market, we're seeing a lot of challenges, and those areas, in particular the auto industry, tend to have a ripple effect through the economy. So one of the other things I wanted to include was that I had a couple quotes. So like the Walmart CEO said that consumer spending would be tougher to predict next year because of rising credit card balances and dwindling household bank accounts. Couldn't agree more with that. And then Lowe's actually predicted a bigger drop in annual same-store sales than previously expected, and they see that inflation has hit consumers and they're spending on their home improvement projects, and 75% of Lowe's revenue comes from DIY customers. So that tells you right there that Lowe's is a little bit more susceptible, and that's why the Lowe's position is one that we have bought and sold out of. Anytime that it drops below a certain level and then moves above a certain level, I cut back that position, and that's just because I think that there's some headwinds coming up for them, even though they run a good business. So I hope that things don't go the way that I'm kind of expecting that they will. But basically, in this case with John and Jane's portfolio, we'd rather err on the side of safety, because when you're in retirement, you can't risk losing everything that you've accumulated over the course of your life. And frankly, they have enough money to be able to live off of. So anyway, thanks everyone for watching these videos and giving thumbs up and likes. I really appreciate it. The YouTube algorithm can be really difficult to understand and work with. It's definitely not as easy as it was when I was on Seeking Alpha, in terms of reaching an audience. So I appreciate everyone and their willingness to watch these videos and give me feedback. Any comments, thumbs up, subscription stuff you can leave me is greatly appreciated. All right, everyone, thanks and have a great day.